Hello and welcome. Today we'll be talking about a buzzer in trade. MedPlus Health came out with numbers and has very strong set of numbers at it, especially for Q4. We've seen same-store sales growth pick up over the last couple of quarters, in fact, and that seems to be sustaining. Essentially, it's up 5%. In fact, first I'll request the producer and directors to actually fire only the one-day chart, because that 5% uptick on the stock price just kind of trying to get an indication as to how it's played out in trade today. There you go. We've seen a bit of a cool off on the stock, but nonetheless, it's holding up very well for itself. Of course, now the 12-month chart kind of reflects that the stock has done precious little over the last 12 months, just 7% in terms of the move, 7.5 odd percent, and of which 5.5% has come in terms of the move today itself. So you've seen a very decent kind of move today versus the last 12 months itself, and the stock has come off the bottom surely. I mean, from that 740 mark at the low point, it's currently at 960. So that's the first piece. Second, I spoke about that same-store sales growth picking up. We'll try and get a perspective as to whether that can sustain going forward and what's giving the management confidence to actually guide for that. And the third piece, it's of course one of the largest pharma distributors, or for that matter, pharmacy distribution chains across India. It's the second largest, to be precise. And it has a little bit of everything in the business, as would be the case with regard to some of these brick and mortar companies. They are not just selling pharmacy, they're also starting to sell FMCG, and now it does its own manufacturing as well and sells its own products which are manufactured in-house by MedPlus with slightly higher margins. So therefore, what we're starting to see is a margin uptick as well, along with everything else that's playing out. The last couple of pieces is we'll try and understand what the 1 to 2 year roadmap is with regard to MedPlus going forward, because in terms of the value, it's trading at the lower end of the price band, which is the multiple at which it trades at, and whether a multiple like that can be justified given return ratios and the like is what we'll try to dive deeper into when we speak with management. But as always, we'll take a bit of a step back. Let's try and understand what the company has been up to and what the company is all about. Incorporated in 2006 in Hyderabad, market cap and therefore south facing as well. That's the other piece I want to highlight. Market cap currently at around 12,000 crores, second largest organized pharmacy retail chain in the country. It manufactures as private label products as well. So that's the other piece that I did speak about. In terms of products, let's quickly take you through what all it sells through its stores. Branded pharmacy, pharma medicines, over-the-counter medicines, private label pharma medicines. This is manufactured, by the way. Private label is nothing but manufactured medicines by them in-house. Branded FMCG goods, which is third-party goods which they sell themselves. They also do private label FMCG as well, but the gross margins for private label pharma are far better than private label FMCG. In fact, double that of private label FMCG, if I've got that right. Health and wellness products is the other thing that they sell, of course, part of FMCG, but baby and mother care products as well. Health supplements and household cleaning products, detergents, cleaners, disinfectants, and the like. Diagnostic tests. Now, this is unique. They actually do collection of, for example, urine samples at some of their stores, not all, and they have tie-ups with diagnostic chains and labs to kind of get those tests through. So that is the other thing that they are doing, which is unique. They also have insurance broking, so they actually sell insurance, and diagnostics also is something that they've started to do, but insurance broking and selling of insurance is the other thing that they do. In terms of channel, and again, interesting, one is the offline channel, of course, the stores themselves are the selling points. The other one is e-pharmacy, and this is where the pickup has also happened in terms of sales. The mix is slowly tilting towards e-pharmacy, which is the online pharmacy where you call for products and that gets delivered home. Not hard for a chain like MedPlus to do because of the concentration of stores that they have in various areas, especially in the south. Mind you, they have 5,400 stores. I'll talk a little bit about that. 5,400 stores, but only in 13 states in terms of the presence. So extremely concentrated in terms of the presence there. And therefore becomes easier for them to deliver straight from the pharmacy itself, from the retail store itself. They also do wholesale cash and carry, which is sales to B2B, which is other pharmacies, say, in the area. Because they procure in bulk, they behave as a distributor as well, and that's one of the optionalities. We'll try and understand what the revenue split on this is like. That's the other piece I'm curious to understand as to what contributes what, because we don't have that disclosure. In terms of revenue mix, MedPlus Health, Metro is around 46%, Tier 1 is 24%, Tier 2 and beyond, in fact, that wording missing there, but Tier 2 and beyond is 30%. Tier 2 is 15%, Tier 3 and beyond is 15%. So that's really the split. So largely what you're seeing is it's Metro focused in terms of revenue mix. And likely, my sense would be that the SSSG growth will also be coming far better in Metro versus non-Metro. We'll get a sense of that. In terms of geography, well, all sales are India sales, as one would expect. Operates in 13 states and 1 union territory. I spoke about that. It operates out of 800 cities. 5,330 stores is what it has. 70% revenue historically is from southern states. But then the tilt also with regard to where the pharmacies are geographically placed, there is a very strong concentration towards the southern states. Out of the 5,000 branches, my understanding would be around 3,500 branches would be southern states. So that 70% kind of adds up. In terms of business model, it sources directly from the manufacturers of these pharma products, manufactures also in its own factories, the ones which it does in-house, and thereafter, which is the private label products, and thereafter it sells obviously through all of the channels that we spoke about. Again, as we always do with every company, let's take a step back, look at how the financials have played out over the last few years. You've seen a decent uptick in growth, right, in terms of top line. 15% growth, not bad at all, but try and understand that SSSG hasn't been a lever which they've relied on at least till Q2 of the last year. Q3 is when we started to see a bit of a pickup. If that lever were to fire, it could really help MedPlus drive stronger growth. What they typically do is they've added around 600 stores in FY26, which means that around 10% of this comes straight from the stores which are added, which is the 600 stores which are added. And therefore, if you could start to see an inch up in same-store sales growth, you could well see this top-line change in terms of the 15% growth it's clocked. That's why so interested in knowing what that number could be and how sustainable is it and what are the levers available to ensure that we're getting that growth well in place. So that's on the top line. Let's talk about the EBITDA. EBITDA has grown much faster than top line. They're doing higher margin products, and therefore what you're seeing is an accelerated EBITDA growth. We've seen a 32% EBITDA CAGR off a low base, of course, of FY23 is what we've taken the CAGR as. And we generally do that because we take the 3-year CAGR, but we give you the 5-year picture over here. So the 3-year CAGR is approximately 32% off a low base. Mind that. The third piece, and mind you, margins will also sink in FY23 as a result of that. So that accelerated growth is on a low base is something you want to underline. The last piece is profitability, and that too, off a low base, has bounced extremely well. So you've seen a 64% CAGR on profitability of, again, a very low base. Let me now talk a little bit about how EBITDA margins have played out, and you'll see that FY22 was a decent margin. We saw a slip up in FY23, FY24, 25, 26, saw a very healthy rebound in terms of margins, and we've in fact clocked a 9% margin for Q4 FY26. Now let's talk, so this is of course a thumbs up as well in terms of operational metrics. Let's talk next about the balance sheet, and the balance sheet looks clean otherwise. It's around 2,000 crore in terms of book value, as you can see, 12 to 13,000 crore in terms of market cap. So around 6 times book is what this one trades at. What you're seeing on the cash side and on the debt side, there's no debt at all. It's absolutely clean, but you have lease liabilities. So lease liabilities from the stores that they already opened, that is something that sits on the balance sheet around 1,500 odd crore, but you've got a nearly 500 crore cash and bank balance which is sitting again on the balance sheet. So no concerns there. Again, a thumbs up from our side. Let's move on and look at how the cash flow has panned out. In terms of cash flow, no concerns at all, of course, because typically all of your EBITDA will convert to cash. what will likely happen every single time is when you walk into a pharmacy, obviously you'll pay up front or you'll pay through your card. So pharmacy realizes the amount pretty much immediately, hardly anything in terms of a cash flow problem from a B2C business standpoint for something like a MedPlus. And logically so, that's what's playing out. Next one, if we can look at how the return ratios have panned out, and that's how the ROCE has played out. Now, for a company which is trading at maybe 40 times earnings, this ROCE, there is still more to do here, and therefore we've given this a neutral. 13%, not exactly the best, but not too bad either. They've been able to manage the worst. At worst, it was at 5. It rebounded fairly quickly. So they are doing double-digit margins. That's ROCs. That is something that they're able to do. But more to be done, of course, and that's what analysts also seem to be pointing out as one of those concern areas for the company. Thereafter, let's look at shareholding. And shareholding per se, there's no concern. There's 40% shareholding by promoters, which isn't a problem. 60% of the promoter shareholding is pledged. So that is one thing you want to keep your eye out on. So around 25% of the company broadly is under pledge. At least that's what the BSE data indicates. And thereafter, you've got a very decent participation of FIs and DIs, as you can see very clearly. Public too owning around 16.5%. So the very good mix in terms of shareholding. It's just that one piece you want to be mindful about. I'll quickly move on to valuations. And, the current price to earnings is 46 times. I did speak about it being 40 something. The 2-year average is 49, and the 2-year range is between 39 and 68. So currently it trades at a 20%, around maybe 15 to 20% higher than the bottom of the 2-year range, and out of which that 5% of that move has come only today. So that is something you want to keep in mind. But broadly, valuations not looking too bad per se based on historical valuations, but you want to keep ROCE in mind. You want to keep SSSG in mind, whether that is sustainable or not. And you want to keep that growth number in mind overall as well when you're giving a valuation which is above 40 times at least for a business like this. Now, analyst recommendations. 9 buy calls, no holds, no sells, 16% return potential. That's clearly a thumbs up. No concerns from the analyst or from the street. And in fact, it was 20% plus till the start of day today. Let me bring on board Gangadi Madhukar Reddy, who's the founder, managing director, and CEO of MedPlus Health. Great having you here, Mr. Reddy. Give us a sense first to start off with. Same-store sales, it's really picked up for you, and that has, obviously been appreciated by the street as well. Give us a sense, sustainability, one, and what are the levers you're using to push that?
So, if anyone has heard me in the past, you would have heard that I really don't think too much about SSG and all, mainly because for us, it's a game where, we have to get the maximum amount of market share. In a city like Hyderabad, we have 450 stores. And our goal is to be the number one guy out there and continue to maintain our position and continue to get better and better market share. As the city or town or whatever, becomes, let's say, denser, we need to put in more stores. And when we put in those stores, irrespective of how well my neighboring stores are doing, they will lose a little bit of sales. So that is not a concern, and that's what affects the SSG. So it may go up or go down based on how densely I actually go and put it in my store. In other words, cannibalization, right? But the thing is, what we really look out for is to see, when we set up a store, does it get to break even within the 3 or 6 months period? Does it get to a 10 or 11 or 12% EBITDA within 2 years' time? As long as everything is going that way, we know we're making enough money and we continue to actually expand. So that's on the SSG side. I heard you talk about the ROCE and all. I think what you should also take into account is the fact that, we're not really counting the 500 crores odd in the bank. If you actually take it out, the ROCEs are going to be much better. That's not capital actually employed. It's in the bank. It's ready for us to employ. And so hence, it kind of looks a little worse than what it is. Otherwise, it should be far better than 13%. That's all I have to say.
Okay. I have a bit of an audio issue, Mr. Reddy. So I'll try to fix that. But while I do that, in terms of new store additions, you've guided that 600 is the benchmark that you're really looking at in terms of new store additions. Does that remain so even for FY27? Do you look at a slightly higher number? And how should one look at the store count increase maybe over the next 2 to 3 years as you ramp up to capture that market share?
So I'll answer this in a couple of different ways. One, today, outside of 500 odd stores, all the stores are owned by the company, right? But now we have a platform which allows us to sell a lot of private label, which has increased the margin and which makes franchising now far more viable than it was in the past. So we have been experimenting with that. We hope that we'll be able to, get a right model out in the next, couple of quarters or so. Once we do that, we think we'll be able to expand far more rapidly. So while we did 600 stores last year, we expect we'll do at least 800 this year, a combination of franchisee and our own stores. I still have to say that the franchisee model is not fully, baked in and all. Once the model is fully done, I think we should be able to grow much faster. So, yeah, 800 at least this year, with the promise that we'll probably be able to do much better going forward.
I have a couple of follow-ups on that, Mr. Reddy. So, out of the 800, how much currently? I mean, I know you're still to iron out that model, but currently, how many would be franchisee? What are you estimating, and how many would be own stores?
I would say at least 300 to 400 would be franchisee, even this year.
Okay. And what's the kind of capex like for franchisee versus own? Franchisee largely would be capex would be done by the franchise itself, or how does it work?
Yeah. So in our model, our own store costs around 30 lakhs to set up, and franchisee store costs us around 10 lakhs to set up. What we do is we actually rent the place and we do the interiors and all. We have the franchisee come in and buy the inventory and start the store. So it is 15 to 20 lakh lesser for a franchisee store than the regular store for us. 30 for this, and roughly around 12 to 15 for the franchisee store.
And if you do get this model right, I'll again take a step back. With regard to ROC, is it materially different, franchisee versus owned?
Yeah, it's going to be better because the money invested is lesser and the returns are more or less the same for us in terms of EBITDA and all. So yeah, the franchisee. No, so we're looking at franchisee mainly as a way to expand rapidly. See, today we have the money, we have the model already set. There's absolutely no reason why we shouldn't be adding 3,000 odd stores every year. Other than the fact that when you add 3,000 stores, you'll be actually bringing in 12,000 employees. You have to train them, bring them on board and manage all those guys. A lot more tougher to do it when these stores are all spread all over the country. So we'd rather, do it through a model in which entrepreneur manages the last mile, which is the store itself. So that's the only reason why we're still not yet basically going to the level of expansion which the model is capable of. And that's why we're looking at a franchisee model.
You're telling me the margins for franchisee versus own stores are the same, sir? So there is no profit element which gets distributed to the owner of the franchise? Sorry, the person who takes the franchise from you. Yeah, please go ahead.
We expect when a franchisee comes on board, he brings in his own efficiency out there, which is what will actually make him the money. I don't think for us, the difference is not very significant.
Okay, understood. And with regard to, so this 800 stores, the capex, etc., will be taken care of based on internal accruals?
Yeah, absolutely. So the capex, even if we were to set up the store completely on our own, it'll just cost us around 240 crores. We have that money in the bank and we're accruing more than that every year anyway.
Yeah, absolutely. Okay, got it. In terms of levers, right? Therefore, would you therefore say that the prime lever is the new store addition which you will do, or would you also look to accelerate more products into the current stores also that you currently operate? Is it only going to be new stores? Is it going to be current stores getting optimized? I mean, you don't look at same store sales growth, so how should one look at that?
See, for us, the product mix is what drives the profitability. we today have private label to the extent of roughly around 20% of our overall sales. While the pharmacy private label has taken a slight dip, and that we actually took a conscious call because we saw that a lot of our employees were aggressively pushing our private label and not really focusing on brand sales. We actually tried to balance it out by making sure that the focus was on selling everything. Hence, the private label took a small, I would say, a dip on the pharmacy side. We don't have any such concern on the FMCG side. That side will continue to grow. So we expect, while SSG could be, it will be what it is. It is dependent on some inflation. It is dependent on some growth and all. But largely, the margins will come in through change of the product mix from brands to private label.
And does that continue to happen gradually? And therefore, what's the kind of margin accretion which will happen maybe over the next couple of years? Would 1% be that number?
Difficult to say. I think we'll continue to grow. That's all I can say right now.
But so what would the reasonable number look like? Would it be 50 bips as private label moves or as the mix moves more towards private label, say every 10% increase towards private label, how much does it move the needle on margins, sir? If you can give us that perspective.
On the pharma side, every single percent, every 1% will improve the margin by around 30 bips. And on the general goods side, it'll improve it by around 15 bips.
Understood. Right now, you're driving sales also through e-commerce. That has also ballooned, right? And it continues to. I mean, you continue to chip away with regard to the mix. Is that also part of the larger strategy to push sales through individual stores? Is that kind of pushing your sales higher as well? And what's the strategy there? How do you differentiate?
See, e-commerce is something which we don't really expect to spend too much money on towards acquiring customers, but we know that more and more customers over a period of time will shift to that channel. Our thing has been to present ourselves as being available through both online and offline, and give the same kind of service in both, same kind of discounts and service in both. So if a customer were to find it more convenient to come online, we are more than happy to serve him that way. But we don't really have a concentrated effort to do that versus this or any other, because the cost of doing that then negates the actual value of getting a customer on board. We expect that as a customer, gets more comfortable with the channel, he'll come on board automatically. And hence, our growth in e-commerce is never going to be as rapid as others who spend a ton of money on acquiring the customers.
I'll ask you very candidly. One, is a 15 to 20% growth likely over the next couple of years? Is that something that you would really build in when you're looking at how the business is moving? And second, this margin uptick that we've seen, I know that you've said that you'll move more towards private labels and therefore margins will likely inch upwards. Sustainable at this level or something slightly higher than this? Is that reasonable to expect?
Definitely sustainable at this level. I think you probably see the same kind of growth we have been seeing over the last, let's say, couple of years and all. So I don't see any problem with that. On the overall growth, I really don't want to give you any guidance on that. But I expect that, if we set up, let's say, 600 stores last year and we achieved whatever growth we did, the 800 store will probably give us slightly better growth. And as I said, if we basically got the franchisee model right, then we should be looking at far faster growth as we go forward. That's all I can tell you for this year at least.
Of 15% ROE, is that something that you target near term? And if so, how quickly do you get that?
I'm sorry, are you talking about sales growth or return on ROEs out there?
Return on equity, sir, Mr. Reddy. That's what I'm trying to understand.
Oh,
is that something that you gun for? Is that something internally that you're looking at?
No, absolutely. Even today, the 13% is not 13% because it doesn't take into account the cash which we have in the bank, right? So it is better, but we will continue to get better as we go forward. Yeah, absolutely.
How quickly do you get there, sir?
Little difficult for me to tell you right now, but yeah.
Okay.
We are going in the right
Mr. Reddy,
direction. Yeah.
no, thank you. I tried. Thank you so much for coming in and speaking to us, Mr. Reddy. This has been good.
No problem. Thanks.
Thank you. Viewers, all the time we have on this edition of the show. Thanks so much for joining us.